Hello everyone, welcome to my YouTube channel. This is Arjun Jayaraman. Today we will talk about Tech Mahindra, a stock that had a volatile swing during the dividend period, and we will also cover some of the options strategies, the adjustments, the trade setup, the market outlook, and especially when the stock can go horribly wrong and dip by 10% from your initial entry price, and yet how you can come out with 59 or 60% return on your investment. Before we start, a quick disclaimer. This is not an advice to buy or sell shares. I'm not a SEBI registered advisor nor a financial consultant. This is just a video for educational purposes. Please consult your financial advisor before making any investment decisions. Before we go to Tech Mahindra, I'd like to talk about Infosys. Uh, Recently had shared a video on Infosys when it was breaking out a channel, and the channel was about 300 rupees height, and we were expecting a target of about 1124. But what actually happened was the stock rallied much higher than that. As we can see, the minimum channel that we see here is usually the channel height for those who just trade based on the channel heights. And for those who trade based on Fibonacci series numbers, the reversal value was around that minimum target level. But however, now the stock has continuously rallied. It has crossed the 262% reversal, and it is now trading towards its 421% reversal level, which is placed around the 1900 zone. Now, the reason why I'm sharing this particular video is that if you notice closely in the monthly charts, there have been two or three very strong sell candles. So we can see somewhere in the end of 2020, there has been a very strong reversal pattern here. Then again, after 3 months, we see one more strong reversal pattern, which also coincides with the 262%. So typically a lot of people would have got short thinking the rally is over here. Then there was a follow-up candle which was again a reversal pattern, but then bulls took all those shorts by surprise. But again there was one more reversal pattern where additional shorts would have happened, and then the stock again continues to rally for the next 4 months. Now people who are familiar with Infosys from the year 1999 2000, the IT bubble rally. During those times, Infosys actually went up to a RSI level of 99 in the quarterly charts, not in the daily, weekly, monthly, but in the quarterly charts. So this stock has a potential to travel really sharp and fast. And people who read books and who attend classes, they typically teach that anything above 70 is a good overbought zone, and around 80 they would avoid buying or they would look for a correction. But this kind of a stock can go continuously all the way to a 97, 98, 99 RSI, and even now the RSI levels are still around the 80s. So we still have quite a lot of time for the stock to reverse. So if you do not have the guts to buy the stock, at least do not short such stocks. Now, why this is relevant? Because we see Tech Mahindra on a similar track. Now, Tech Mahindra, I had recommended the chart for educational purposes when it was decisively breaking above the quarterly charts in a 15-year, 16-year channel, right? So the target at that point in time was about 400 rupees, which is the width of the channel. And we can see that within 1 quarter it has moved up significantly to 1463, and we are just about another 120 rupees to the target. So till we see a proper reversal, which could be either here or it could be an extended target, it's better not to short such stocks, as you have seen what can happen in a stock like Infosys. Similarly, Tech Mahindra also has that huge potential. So quickly moving on to the strategy with adjustments. Tech Mahindra had a special event during the month. There was a 30 rupees dividend announced to be paid on 23rd July before the expiry. the spot price was trading at 1087, and the futures immediately corrected by 25 rupees, and it was trading at 1062 after the dividend news. The view we have is bullish to moderately bullish, because we have a channel breakout and we are expecting the stock to rally up further. But whether it will happen before the expiry or after the expiry in the next month, we do not know. But still, the strategy is to buy deep in the money call option and sell an out of money option. So if we were to buy the futures, the margin is about 2 lakhs. So we wouldn't know how far it can fall or it can rally. So better to limit the profit or loss. So the strategy is to buy a call and sell a call, so that the maximum profit can be about 30,000 rupees. The maximum capital deployed is also about 30,000 rupees, which is a fantastic ROI. In the event of a loss, the maximum loss can be only 18,000 rupees, or which is about 30 points. For a stock like Tech Mahindra, 30 points is nothing, because the stock can rally 100 rupees in a single day. So this is the trade setup. So from the time of entry, the 1040 call was trading at 49 rupees, which was almost at 1089. If you were to look at it from the spot price, it is hardly 2 rupees of extrinsic value and 47 rupees of intrinsic value. So we are selling the 1120 call option for 19 rupees premium, which is still 40 rupees outside, and we still have a good opportunity to roll up further if the stock price moves up. But however, what happens, the stock starts falling below the very next day, and the spot price fell to 1055. So we buy the 1120 call to exit the stock with a profit of 6,000 getting booked. We do not book any losses at this point in the bought calls, and we roll down the calls and sell the 1100 call for 12.5. Now within a couple of days, the stock falls really badly. In fact, it falls below the deep in the money option strike price of 1040. The spot price was 1030, and this is the advantage of buying a call rather than buying a future, because if you had bought the future, then it would have really fallen down by almost 50 rupees. But however, here we are seeing a decline of hardly 30 rupees. So what we do is we kind of exit that stock, because we want to take price advantage, because what we are holding right now is pure extrinsic value when the stock price is below the call price. So we will exit the trade 1040 call and buy the 1000 call, which again gives us a fairly 34 rupees, which is 1034. When the stock is trading at 1030, we still want to be in the money with a high probability of expiring within in the money. So while we book a loss of 18,000 rupees, we also roll down the calls, right? So the 1100 call is bought, and we are also looking at an additional call. So because there is a rationale, we can see that in the 5-minute, 15-minute charts, there has been a very strong reversal with a very strong negative divergence in the MACD as well as in the RSI. And it looks like a bottom, because we also see the stock dipping below the Bollinger Band and kind of reversing back. So these are some technical reasons why we take an additional buy position. So basically we buy 2 lots of 1000 call options, and the same day the stock rallied up. So the idea is just to hold 1 lot, not 2 lots. So we don't want to add further positions here, so we exit that difference the same day with an additional profit of 5,000, which will help to offset this 18,000 loss in a little way when we book the profits. So but we don't want to keep a naked call option of 1000 call, so we are also selling the 1060 call option for 17 rupees premium. So again, we have a vertical spread here. So as the stock rallies, so does the price. So we exit the 1000 call option, and we buy back the 1060 call option, which was still trading more or less at the same price, and then we roll it up by 20 rupees to move the 1000 call to a 1020 call, and the 1060 call gets rolled up to a 1080 call. Similarly, when the stock again dips, once again over the next couple of days. We do not know how far it will fall, right? It can fall once again way below the Bollinger Band, and the entire trend could reverse. So we don't want to wait for that. So we kind of roll down again back to the 1060 call, and we take a little profit here in the roll. And once again, the stock starts moving up. So then we roll it back to a 1060 to 1080, and the 1020 call moves very significantly in the next 2 days by almost 40 rupees. So here we typically sell volatility, and especially when it is touching the upper side of Bollinger Band, and we know that the dividend period is still ahead, so mostly there will be some more corrections and the stock might not go up in such a hurry. So we are kind of trying to take advantage of that, and we booked 22,000 rupees here as a profit, because this will completely offset the 18,000 loss that we booked earlier. Plus we get to keep all the additional roll up roll down profits that we have made so far in this in these trades. So the next day we see again a strong pattern, which is usually followed with a negative candle or a lesser close price candle often for this particular pattern. So looking at that, again there's a little adjustment of moving the calls to a 1060 and 1100 call, and then after that the following day the stock moves up. So there is again some more adjustments. 1100 call is bought and 1120 call is sold. So basically we are rolling up once again because we see a strong up move, and again there has been a correction from that high all the way to the low. So again there is a roll down that is happening, and this time there is a Eid holiday as well coming in, so it's a long 3-day weekend. So then for the 1060 call we need a hedge, so then we kind of sold the 1100 call here. So the next day it kind of moves up. During that time we roll up once, and the 1080 call is finally closed here, and all the profits and losses put together in about 12 trades, which happened as 11 adjustments, but practically they happened in just about 7 or 8 trade sessions out of the total 15 days. You don't need to be looking at the market all the time, you just need to spend 5-10 minutes in a day to see where it is during a coffee break or during your lunch breaks, and then you can still make these kind of adjustments. And you can comfortably work on other things, because you know the maximum loss you will take in this entire trade is just about 18,000. But you will not have this peace of mind if you are long in futures for this kind of a swing. The MTMs could be pretty high. So it is always preferred to stay in the trade with a good probability of profit, and with a good probability of the stock expiring above your purchase price. And if it falls, better to have a hedge by selling a call which will make it a vertical spread. And these kind of strategies are very helpful to trade in a directional strategy. So one thing that you would need to notice is, right after all this exit happens, the stock can actually trade really fast and go up like a rocket by 300 rupees. And this is bound to happen. So if you have invested in equity, or if you have just bought futures and held on to it for like 3 months, you could have made a fantastic rally here. But if you're risk averse, you don't want to really get into futures, you don't want to invest that much, you just want to take a little risk for a little return, these kind of strategies are highly profitable. Thank you very much for watching my video. Next week I will come up with a video after the month is over. I will cover Bharti Airtel and Grasim, which has been moving really significantly on the higher side. So we will cover those two stocks in the coming week. So thank you for watching my video. Please subscribe to my channel and hit the like and bell buttons to get more notified about more videos like this. Thank you very much.